Welcome to The Explainer. Today, we're taking a close look at a financial product that thousands of Kenyan parents sign up for every year: education insurance. It's sold as a promise for your child's future, but that promise comes with some really critical fine print.
Let's just start with this observation because it really sets the stage. The intention behind these policies is, without a doubt, a good one, but the reality can sometimes be incredibly painful. We're here to figure out why that is.
At its very heart, the idea is powerful, right? It's a promise to your child, a way to guarantee that their school fees will be paid, no matter what life decides to throw your way.
So what is this thing exactly? Well, think of it as a two-in-one product. It's designed to solve a couple of a parent's biggest worries. On one hand, it forces you to be disciplined with your savings. On the other, and this is key, it provides a safety net in case of the unexpected, like death or a serious disability.
Okay, let's really dive into this next part, because this is probably the single biggest misunderstanding out there. And getting this wrong, it can cost you a lot. This isn't just about words. It changes how you should think about the entire product. So often you might hear language like grow your money, and naturally you start thinking about high returns, like a great investment. But how does an education policy actually perform when you put it side by side with a real dedicated investment?
And this chart just lays it out so clearly, doesn't it? An education policy is a safety net. Its main job is protection and forcing you to save. A money market fund, on the other hand, is an engine. Its only job is to grow your money. They have totally different purposes, and you need to know which one you're buying. But what does that really mean in your pocket? Let's talk actual numbers. Once you subtract all the fees, the cost for the insurance part, and the admin charges, what are you actually left with? Well, an education policy typically gives you a return of around 4 to 6% a year. Now that's stable, it's predictable, for sure. But, and this is the crucial part, it's not designed to make your money grow fast or to beat inflation by a long shot. Okay, so let's compare that to a product that is purely for investment. What kind of returns have we typically seen from something like a money market fund here in Kenya? And there it is. That really tells the whole story. You're often looking at double, sometimes even triple the returns. They are completely different financial tools, built for completely different goals. Don't let anyone sell you an insurance policy as a high-growth investment. So now that we're clear on the returns, we have to talk about the risks. Because this is not a flexible savings account you can just pause whenever you want. When you sign that paper, you are entering a serious, binding legal contract, and there are consequences for not holding up your end of the deal. This word right here, lapse. It's the one word every single policyholder needs to understand, and frankly, be a little bit afraid of. It means the contract is broken. And when that happens, the insurance company's promises to you, including that critical life cover, are off the table. And the process can be shockingly fast. It all starts with one missed payment. Then a clock starts ticking. That's your grace period, usually about 30 to 90 days. If you don't catch up by then, the policy lapses. It's terminated. You might get some money back, something called a surrender value. But notice those two little words, if any. They are very, very important. So here's the part that catches so many people out. Timing is everything. In the first few years, especially the first 3, most of the money you pay isn't actually going into your savings. It's going to cover upfront costs, like the agent's commission and admin fees. That means if your policy lapses early on, you could lose every single shilling you've put in. And look, this isn't some deep, dark secret hidden in the fine print. The industry's own association is very clear about it. If you cancel early, what you get back is almost always going to be less than what you paid. All right, enough with the definitions. What does this actually look like for a real family? And what happens when the policy actually works the way it's supposed to? Let's look at 2 stories that show both the devastating side and the incredibly powerful side of these policies. So first, let's meet Grace. She's a teacher, and for 2 years, she did what she thought was the absolute best thing for her daughter, diligently putting away 5,000 shillings every single month. But then, well, life happened. It does that, right? She lost her job, and suddenly that rigid, non-negotiable monthly payment just wasn't possible anymore. She missed a few payments, and her policy lapsed. So, after putting in 120,000 shillings of her hard-earned money, how much did she get back? 0. Nothing. Not a single shilling. Because it happened in that critical early window, the surrender value was 0. Now, on the complete other side of the coin, you have Mary's story. And this is where the product shows its true power.
Tragedy struck, and she was left disabled. But because she had this policy, it became the safety net it was designed to be. The insurer waived her future payments, and her daughter's education was completely secure. This right here is the why behind education insurance.
Okay, so how do you avoid Grace's heartbreaking situation and get the peace of mind that Mary has? It all comes down to being informed and, more importantly, being proactive. So let's talk about your action plan. If you are even thinking about getting one of these policies, you have to do your homework. Ask to see the surrender value table. You need to know exactly what you get back if you had to stop paying in year 1, year 2, or year 3. Ask about every single fee. And be brutally honest with yourself. Pick a premium you know you can afford, even if things get tough.
Now, what if you already have a policy and you're starting to struggle? The number one rule is, do not just stop paying and go silent. That's the worst thing you can do. Pick up the phone and call your insurer immediately, before the policy lapses. You have options, but they disappear once that grace period ends.
You know, there's a Swahili proverb that just sums all of this up perfectly. Usipo ziba ufa utajenga ukuta. If you don't seal a tiny crack, you'll eventually have to rebuild the entire wall. That small, proactive phone call to your insurer when you're in trouble, that's sealing the crack. Ignoring it could cause your entire plan to crumble, forcing you to start all over from scratch.